The fool with a tool still stays a fool. So, do you join me today? Let's talk about education and cycle analysis today, as the noise out there in the markets is too high. So this episode is dedicated to a very important knowledge aspect everyone should be aware of when dealing with cycle analysis. So welcome to another episode of Cycles TV. My name is Lars von Thienen. Welcome, as always, to this show. Today, as mentioned, education. But before I will dive with you in that topic, let's please recognize that we all want to meet you in June. Yeah, so I hope to see you there. Great place to meet. So, what do we talk about today? Relax a little bit and please listen and join. It's a very important but a very complex topic. I will try to make it as simple as possible. Let's start here with some physics. The Heisenberg uncertainty principle, in its time-frequency form, states that the more precisely you know the frequency of a signal, the less precisely you can know its duration or time, and vice versa. Have you thought about the implications of that statement? This is physics, which we need to take into account, which purely means the more precise we can detect the cycle in the given data, the less precisely we know where it is in the time domain or the duration. And this is a knowledge every cycle analyst should have in mind when looking at some kind of frequency analysis, spectral analysis, spectrogram, periodogram. If you see that kind of work outside, you really need to be aware what that statement means. And I will walk you now through two examples to hope to really make that clear, that not always a simple tool will help you out of that. You need to really understand what that means. Okay, let me try to make it simple. Let's start with a theoretical example. So we will not deal with market data today. We will deal with virtual data to explain the principle. So what you see here at the bottom are three cycles. Yeah. So just focus at that situation here where we have three cycles which are overlaid. So this is the frequency where we detect the cycle length, the phase and the amplitude in the frequency domain. And by doing that, we know that we have one cycle, or by adding that information, we have a cycle with a length of 110 bars. Yeah, that's the blue, the longer one, the duration 110. We have a second cycle with the duration of 50 bars, which is the green bar here, so the length of 50 bars. And we have a third cycle with a wavelength of 30, which is the smaller cycle you can see in that screen here. So we work with a set of three cycles. So we are now in the frequency domain where we define three cycles, which means we have three clear information out of the frequency domain. So when we speak about cycles, it's frequency. And in that sense, we have the exact information in the frequency area about the length, 110 bars, 50 bars, 30 bars from the frequency domain, right? So this is where the cycle analysis takes place. If you just add those three cycles up and then plot this over the time axis, which is the dark black line here, this is the composite on the time axis if you just add up those 3 cycles continuously over time. Yeah, so we can see that just by showing you that example. Sorry for that. Let me just turn the first cycle off. The second and the third. So you see that I will build just a composite. So that's the idea. I hope you get it. We take 3 cycles in the frequency area where we know the exact parameters of those 3 cycle lengths. We add them up, we plot them over the time axis, create a composite in then the time series, which is equal or similar to a price series data set. Enough said. This is how it looks like if we bring this data now into our cycle scanner. So this is the composite plot now in the time domain. Yeah, so that's exactly what we need to differentiate. When we just see this kind of series over time, yeah, it's not a time axis, but the theoretical data set starts at the 1st January of the year of 2000, and then 1 bar is 1 day, and we continue over the time axis. This is a time series in the time domain. So by adding up all 3 cycles and their phases and the length, we create a composite line in the time domain, which looks like this information here, right? So now maybe you will find it quite simple. If we do a frequency analysis, we can now clearly identify those 3 cycles also in our spectrum. If we apply frequency analysis on this time series, we, the other way around, no surprise, detect those 3 cycles. First cycle, length of 30, second cycle, length of 50, third cycle, length of 110, 111 here. So, I mean, by design, that's nothing new. So that's what we expected. And maybe you start to think, Lars, what do you want to explain us here? So that's what we all have learned and using, and what we're doing now. We build a composite out of those 3 cycles, which in that case is exactly the way. And then we use those cycles for forecasting. That's the purpose. And now the tricky part comes as we are dealing with time into the future. We assume that those frequency components are also reliable on the time axis. We do our forecasting here. So here the data set ends, but we can now continue to plot that series into the future. Yeah? Or we can just use 1 cycle with a length of 110. You see here as an overlay. That's quite simple to do that. Okay. Why I'm telling this? So let's now do it a little different. So let's assume we again take a series out of 3 cycles, 1 cycle length of 30, 50, 110. In this case now, we don't overlay them on top of each other. Instead of that, we create this series here on the time axis. So here, the first iterations are the iterations of the cycle with a length of 50. Yeah. Then we see the cycle with a length of 30. And then it switches and we see a cycle with a length of 110. So same time axis here. Instead of just stacking them up, we just add them to that time series. What do you think how the spectrum will look like if we analyze this complete different data set on the time axis, now looking at the spectrum? Could you imagine how the spectrum looks like if you try to keep in mind how the first spectrum looks like? Let's do that. Here's the spectrum at the bottom of this series here. We have a clear peak at the length of 30 bars, we have a clear peak at the length of 50 bars, and we have a clear peak at the length of 110. So, complete different time series, same spectrum. I can now switch forth and back for those two data sets and have a look at the frequency spectrum here. So this is where we just have one cycle at a time, just sequenced of those 3 cycles. Here we have the series, all 3 cycles just stacked up to build a signal. I will now switch forth and back even more fast. So you can see, just have a look down here at the spectrum, right? I will switch between those. See it, right? Exact same spectrum. Can even make it larger here. Okay. Now maybe you try to get my point here. So, yes, frequency analysis is able to detect those 3 cycles in the data series, but it completely loses the information of time when those cycles have been active or not active in the data series. So you lose all information about time. So if we measure as exact as we can in the frequency domain, and we can this by precision now, with what we are doing here at the foundation. By precision, we can measure in noisy data and trendy data, really measure the relevant frequency cycles here. But as you see in the time series, we completely lose the information about when each of those cycles have been active or has not been active. We have no information about the time when those cycles have been present or active in the data set. So, and that's, I mean, maybe pause here or review that video, think about that statement. Because it's very important in terms of now thinking about forecasting, doing a projection. Because from a statistical perspective, maybe both analyses have been right. Yes, all 3 cycles have been present in the same way in the whole data set. Okay, so that's not the point. Frequency analysis is able to detect that. But we want to get back to the time domain. Once we have our cycle information, we switch to the time domain. We look at price charts. Price charts happen and come in the time domain, not in the frequency world. So our decision making, maybe in regards to trading, happens not in the frequency domain. We don't trade frequencies. We need to make decisions on the time axis based on price information. And that's where you need to be aware of that the information about when whatever cycle was active at which point in time will not be shown by a spectrum, will not be shown if you look at the table which cycles have been in the data series. And I will come to the looking forward, but I will very often just see people stating, yeah, Fourier analysis or whatever, digital signal processing, it's so easy here. You can do this in this application, that application. You can even put it as an indicator on a chart here. Then you see a spectrum. Okay, I use the peak in the spectrum, do a projection. That's it. So that's the reason. If you do that without knowledge about, you lose the information about time on cycles in this frequencies domain. And then you purely assume, okay, these cycles will repeat forever. So then you activate the dominant cycles and just project this into the future. You have no clue that those cycles will be there, have been there forever. Okay? Before I now repeat myself too often. That's really the point I want to make here. So let's assume we want to have a projection here for this data set. And you see the last active cycle for the last 5 years, I mean, hypothetical example here, was the cycle with a length of 110 here now in that case. So does it make sense to use a cycle with 30 or 50 for forecasting? No, for sure not. The cycle with the length of 30 was active in the very early stage from the time information here, or in the center. So this is the 30-day cycle here. So completely nonsense to use that cycle for projection from this point in time here. So this is what we are interested in. We are not statistical interested in that overall signal. We are interested in finding the right cycle for the current point in time now, doing a projection into the future. And looking at that example here, the only useful way would be using the 110-day cycle, or 111 here in that case. I could explain the deviation, but that's not the case for today here. Yeah, but it's not shown in the spectrum, right? So from which information we derive, and you won't see it in the original data series that easy how it is here. So which information can we use now to derive the knowledge? Okay, one thing is the spectrum, detecting the dominant cycles in the data set, but which one to use for projection, because that information gets lost. Heisenberg principle, yeah, physics, if we are able to detect those cycles. And now additional techniques come into play. And one technique I have used very often on this channel here relates to a cycle highlighter method. I have discovered, do we have the book? Yeah, I have the book here. Let me just reference the knowledge. It was first written by Brian Millard, a tribute to J.M. Hurst, Channels and Cycles. To be honest, this book is not one of my favorites, but there is a small chapter. There is a small chapter in that book where Brian Millard exactly comes to the question about how to visually spot if a cycle is currently, not on average, active in the signal or not. So therefore, the original idea I will show you, and I've extended that idea in my work for the past 15 years, always goes back to that simple information. And if you even want to know more about that, a little bit promotion here, but it's not really a commercial promotion here. In this book I wrote 14 years ago, Decoding the Hidden Market Rhythm. Maybe you know about that. Every bookstore will have it, and it's not about a commercial information here, but I made a specific chapter here. So therefore, just to tell you, this is a very old and basic principle. Let me find. Maybe just the not well. Maybe, okay, doesn't matter. I just want to state there's one way to do it, and this is also embedded in our platform here. So let's start, and you can activate the cycle highlighter as a visual plot with the info box here, which gives you at the bottom. Hope you can see that on your screen. I will zoom in. So at the top you see the original data series, and at the bottom you see now, for what I've chosen here, the 30 days cycle, which is plotted here as the red theoretical cycle, as an overlay over the dotted blue data, which is the real cyclic component in the data series. And if you would have a match between the theoretical, in that case 30-day cycle, with the extracted cyclic information here in that sense, you would have a visual confirmation of a fit, and you only see that confirmation. So if you go back in time, that will only happen and at that point in time. So imagine you will never see that in the original series that way. So ignore the original data series. Just by using that highlighter information, you know that this cycle was only valid until May 2005. And at that point, that 30-day cycle has completely gone out of sync. So this is nothing you can really lose at this point in time for forecasting. Let's do the same for the 50 days cycle. Same information here. You see it's quite out of sync, the red one with the blue information here. And if you scroll back that information, even in that period here, and when you find a season or a point in time when we have a match between the theoretical red 50-bar cycle and the highlighted real price information cycle, then you have a match and you see that that cycle was active. So in the early stage of that time series, you see it here in that window. And then this cycle has gone out of sync. So we're trying to get information about time again, because time information was lost deriving the cycles. But now we need to get other methods to help us getting in information when, on the time axis now, when those cycles have been active and have not been active. So that's one way. And now we choose the 111-point cycle. And here we see that cycle clearly out of sync in the early stages, but now in the past 5 years, you clearly see, okay, that cycle is really in sync with what happened in the real price information. So by switching between those three cycles and the visualization of that cycle highlighter, you can clearly identify at the current point in time, because that's the only information we are looking for to use this for projection. That's the way why we need to know, we get back to the time information, which of those three cycles here at the bottom is currently active. Lost in the spectrum, but the cycle highlighter is one method to get this back. Now, if you look more closely, that's also the reason why it depends. Let me get that out again. So maybe one takeaway is, hopefully you understand what the spectrum and the cycle information gives us and what it does not give us. So therefore, we need to do a little bit more analysis before using something from that cycle analysis for forecasting. One way is that visual plot comparing the theoretical cycle and the isolated cyclic information from the original data series, and then do a comparison. There are other methods, but it's just one, and I just wanted to highlight the original source from where this idea is coming. It's embedded in the platform, but sometimes you see me activating that feature. Hopefully now you understand why I'm doing that. Another way to overcome that missing information on the time axis is, we often talk about persistence of cycles. So the persistence of cycles is a statement which gives you an information at which point in time in the past was that cycle present. So that's you do the analysis over time, and at each given point in time you validate if that cycle was active. That's persistence. So if you hear the statement cycle persistence hopefully you can better correlate it or think about, what does that mean, looking at this example here. So if a cycle is not really persistent over time, which means it is just in the past active at some point in time, but maybe not today, or you need to derive that if you have poor persistence of cycles. Another topic to overcome this problem is never use as much data as you can. You also see me that I'm talking about, let's not use more than 3 times of the maximum cycle you want to detect in your data series, because if you add more data, for sure the spectrum will identify more cycles, because the more data from time perspective you give it, maybe for sure there have been cycles in the past which have been active. And yes, the frequency analysis will detect them. But are they important now, today? You lose that information, and that's the reason, if you throw in too much data in your frequency analysis, it will not really help you to get better data out of it. That's another topic I often tell you here, not to use too much data going into the past, because it will make it much more complicated to derive afterwards which cycle is the one for prediction on the time axis. Yeah, because that's what we always need. So that's another topic. So hopefully this inspired you a little bit, thinking more about what cycle information is and what shortcomings it also gives us if we switch back to the time domain. I think we need to have that in mind. Even if we before we feed algorithms or try to build automatic trading systems or use auto composites, just activating all cycles which pop up in the spectrum. Barthel score does not really help us out there. Strength is also not a final measurement. The prominence ranking we have is also not a final way to overcome that. So it's not really simple with one measure. We are moving forward in the foundation with building new algorithms, also to bring this into a measurable score. But we are not finally there yet. For me today, it was just important to bring this message across. And finally, I mean, if you are coming from that science or PhD in math and engineering, for sure you will throw at me, but we have the wavelet transform, which is bridging that problem. That's true. So the wavelet transform overcomes the issue with dealing with being only exact in the frequency domain. But the error rate will grow. So, and that's due to the Heisenberg principle. So if we want to detect both frequency and where are we in the time domain with one single algorithm, we lose resolution. So we lose the exact information. So wavelets can combine both aspects, but believe me, I've done a lot of tests with wavelets. So the error rate is so high, or the resolution is so low, that for projection we have a lot of error rates by 2, 3, or 5%, which really will make cycles also then off. The error rate is too high. Maybe that helps in statistical analysis, but not really for forecasting. So wavelets don't overcome this. They seem to, but we lose too much resolution to give exact forecasting. That's it for today. Maybe I need to pause here. I hope to explain it a little bit more from a pragmatic point of view and not from the mathematical terms behind all of these issues and problems which arise with cycle analysis. Maybe just a warning, therefore, be careful with overly simplified Fourier or spectrum analysis you might see on other platforms or even as indicators in charting platforms which give you a spectrum. Yes, Fourier analysis is quite simple, but as said, there are a lot of shortcomings you need to understand before you use a cycle in forecasting. So let me now move to your questions in the chat section to spend some time there and to see what you have on your mind right now. So, Andrea, that's exactly one point. Is strength the key here? Not finally, because strength is just an average of that cycle length compared to the time scale we are analyzing. So it's not really giving us the information which is at this time the most important one. So therefore strength will not really help us out here. Mark, nice to see you. Moin moin. Yeah, okay. All your other questions are more related to real data again. So I will not apply this to real data because it's even more complicated. And that's maybe last sentence. In the real world, it's even more complicated as we have noise, we have trends on top of that. So and that's why wavelet or other information is not able. If we increase the error rates with using wavelets, but then deal with additional noise and trends in the data series also, the error using all these algorithms which try to bridge everything and do an average best guess of this and that really does not help us out. So that's the science of cycle analysis, maybe also the art of cycle analysis, or the art of cycle analysis now applying this back on the time axis for financial assets. Let's call it that way. It's easy to learn to play guitar, how you need to put your fingers, but it's not easy that it sounds good. Playing music does not mean you just learned how a chord on the guitar will look like. And that's maybe the difference. Detecting a cycle does not mean you are able to play the markets. Let's end with this comparison maybe. Yeah, I have chosen that example for today, to be honest, because as the noise level in the markets today is so high, it makes not any sense to use a real world example, because cycle analysis won't work if the noise level is so high as it is right now. All right, let's close here. Let's close for today. If you want to discuss this kind of stuff, please think about if you will join us in June this year in New York. See you there. Otherwise, join me next week, Monday, same time, same place. See you there. Bye.